Welcome back to my channel, Balance Sheets Matter. In this video, we're going to be looking at Mastercard and do a stock analysis. But before we get into the analysis, make sure to subscribe to my channel, Balance Sheets Matter. I do individual stock analysis videos, so if you like getting good ideas of potential stocks to buy, value traps to avoid, make sure to subscribe to the channel. And of course, like the video. And if you do want me to look at a stock, leave it in the comments below, because I do get the subscriber requests, which Mastercard here is basically a subscriber request video, which we are going over now. So basically, looking at some of the top-level metrics for Mastercard, we can get a kind of brief idea where the company's sitting at. And sometimes this guru-focused value band for predictable companies, which Mastercard has been very predictable in the past, and it may be going forward in the future, but we will discuss a few things that potentially could be headwinds for Mastercard going forward. It is indicating that the stock could be a little bit on the undervalued side. And then we look at the PE right now, it's sitting at 29, and really for a company that grows as quickly as Mastercard, a PE of 29 really is actually not that high, and they have a forward PE of 25.5. And we get down to the dividends and buybacks, basically how they're returning capital to shareholders. You can see they have a very, very low, basically token dividend yield of 0.67%, and they have an average buyback yield of 2.2% per year. And this is one of these problems that you kind of get with these companies that are growth companies but trade at higher PEs, is when they buy back shares, they really actually can't return very much capital to shareholders this way because of the higher share price, which almost like would favor be, in my opinion, that they pay a little bit more dividends. Maybe that lowers their EPS growth a little bit, therefore, because they're not buying back as many shares. But then with the share buybacks they do, it's able to be a little bit more efficient and not at highest prices. So looking basically at their EPS and revenue trends here, you can see the blue line here has been the revenue trend line, and basically that's been about 12.9% per year on average. And the analyst estimates, the green, which you can hardly see because Mastercard is a very consistent company. And honestly, with the financials, there's not too much to go over. This is mainly going to be a valuation question. I'm just going to be bringing up some of the key things that we need to look at to actually determine where the valuation may be going forward in the future. But right now, the current analyst estimates are expecting basically this trend to continue. But if we look at basically the growth rate on a per share basis, the last 10 years has basically averaged 15%. And well, you take your 12.9%, add in those share buybacks, well, it comes to about 15%, basically. So that's why the growth rate for the revenue trend per share has been 15%, and the EPS over the last 10 years has been 17.2. And this has been a little bit higher because they have been able to increase their operating margins, as I will show you shortly. One of the first things to basically look at, well, not super relevant for Mastercard because they typically don't actually have to invest a lot in their company, but they do basically a little bit, is the return on invested capital. And you can see it's sitting very high. Basically, since around 2020, it's been more around this 40% range. But the key thing to kind of look at, there has been obviously a little bit of a change, basically from pre-2020, when the return on invested capital was sitting in the 60%, sometimes closer to 70%. So this is something that is lowering a little bit over time. And that's just something to keep in mind, that the returns they're getting and the amount of money they're investing into their capital or acquisitions basically isn't as efficient as it quite was, maybe like 5-10 years ago. But getting into the financials, you can see they have basically very high gross margins right now, sitting at 77.61%. And, historically it was maybe marginally higher before, but this is such a inconsequential change, I really wouldn't consider it any decrease basically at all. And where they have been improving a lot is they've basically been improving the operating margins over time, because as basically their top line revenue grows, just to do more payment volume with Mastercard, they don't need to increase basically their selling and general admin at the same rate. And this is the reason the EPS basically has grown at a faster rate than the revenue. Although kind of based on the analyst estimates, as we'll see going forward, they are expecting this not to increase at kind of this same rate as it was before. And there is kind of a limit that it does kind of have to slow down and cap at some point, but we don't really know when that's going to be. And they do have a little bit of interest expense, sitting at about $725 million, which is relatively very, very little money compared to the operating income of over $20 billion. So, they're sitting at a very, very, healthy portion. And that I usually say, you look for about a 1 to 10, ratio, and they're sitting like way above that, closer to a 1 to 25. So that's a very low interest expense, basically compared to the operating income. So that kind of indicates us the debt they have is a very healthy amount. And typically you get these other expenses. These are typically due to write-downs or other little things like that, which, are typically non-cash expenses, but, they kind of do get factored in. You can see there's been a few increases in the past, but on average, there is a little bit of write-downs basically per year. And this like, kind of comes down to the bottom line. And basically after the, tax cuts there were in the past, basically, they're sitting at like a really, really high net margin of almost, 45%. So that's like, very good, basically leaving the EPS at 17.31. And you will see they do some share buybacks. But again, if you kind of look at these numbers, it's actually like very, very minimal, like a billion, 6 billion shares down to 992 million. Then 992 down to 971. These are not big jumps. It's only around that 2.2% per year because Mastercard typically trades at a high PE ratio because they are a high quality company. They are growing at faster than average rate. But when you do share buybacks, you just can't buy back as many shares, which is kind of the downside of that. And their balance sheet, there's nothing too remarkable here. It's like basically the current assets, $22 billion, basically equaling the current liabilities. Healthy enough for them. You got your total current assets at $52 billion. Although you do need to keep in mind that they have been doing acquisitions basically over the years. This usually isn't completely new businesses and separate lines. These are kind of more things that create synergies and are useful with inside their own business. They're probably acquiring that they feel it's basically cheaper than to develop themselves. So that's going to be a little bit kind of relevant as we get to the cash flow statement to factor basically that into their purchase of plant, property, equipment, because instead of that, they're kind of doing these little acquisitions instead. And basically with the liabilities, they do have total equity of 6.7 billion, but if we took out the goodwill, that would be a little bit of negative, basically total equity, just, to keep that in mind. But overall, pretty fair balance sheet. We'll just, you can look at the long-term debt here, $17 billion. It's a, very low interest rate they're basically paying. So their debt is really not a big concern. And well, this actually has decreased a little bit over the last bit. They don't really have any big incentive to actually pay this debt down because their operating income is so much higher than their basically their interest expense there. So getting into the cash flow statement, the one thing I always like to look at is we look at the cash flow from depreciation here and basically, see what the purchase of plant, property, equipment is relative to that. And you would expect a company like Mastercard to be on a little bit higher side because that's typically how basically you grow. And that does mean basically the net income you are seeing when this is basically your purchase of plant, property, equipment is higher than your cash flow from depreciation. It means your actual free cash flow compared to your net income is going to be a little bit lower on average once we kind of take out all these other, year to year or month to month, changes in payables and working capital, etc. And you can see it is a little bit higher, actually not much though. You can see like about 1.2 billion compared to like, 1.1. This was, 1.2 compared to 900. So it is, higher. That's, healthy for a growth company. But you also kind of do have to factor in these purchases of businesses because if you kind of do look at it, they're not separate streams of operating income they're making. They're things, basically different services like, fraud management and this and that kind of work in conjunction with their existing Mastercard, basically, business there. So you kind of have to take these and average these a little bit into what the purchase of plant, property, equipment is, because basically they're buying these rather than developing these systems in house. That's kind of what it looks like. And if you add these up here, that's like 4, 6, 7, 8, 9, like that's like $10 billion over this last 10 years basically say. So when you actually kind of factor this into the purchase of plant, property, and equipment here, all these years are almost $1 billion higher. So you kind of have to realize that the company is investing a fair back like a relatively, compared to the purchase of plant, property, and equipment, a fair back into themselves. It actually is on average has been higher than the purchase of plant, property, and equipment. And then we can basically see, they buy back, a lot of stock with basically all that excess capital. And then they issue this like little token dividend. Again, I think it would be better if they just shifted a little bit this back into the dividend. Maybe that would slow down, like lower the EPS a little bit and make actually a repurchase of stock a little bit more efficient. But when you kind of do look at their free cash flow, they basically do take everything. They pay their little token dividend and they do everything else for basically the repurchase of stock after they've, done what they need to do in their business. So basically that's like, with Mastercard, their financials very consistent, a very predictable company. It really just gets down into the valuation of what is a good valuation basically for it and what are the headwinds. And I'll just quickly kind of go into the headwinds because one of the things that was brought up this year but not enacted on was basically Trump was, wanting to basically cap credit card interest rates at 10%. And well, Mastercard itself is not the one charging the interest rate. This would tighten up basically consumer credit, and therefore there'd be a slowdown in their growth overall, which would affect them and would affect their potential basically multiples, your P ratio, basically going forward of how we value the company, as we'll get into. And this is actually not just a partisan issue; it is a bipartisan issue because even a little bit after this, Bernie Sanders he proposed capping the interest rates at 10% as well. And if you may have heard, there's other companies that are like Dave or Klarna, and they have a kind of a different model too of offering credit to lower income people who do need credit. That is somewhat of a competition to credit cards, but really what gets into that is the regulation around it, because the interest rates on credit cards are relatively on the higher side because you kind of have to lock people in with, oh, we're giving this amount of credit and we can't be changing the interest rates willy-nilly over time. So this is a very highly regulated industry, and this is just a potential headwind that basically could sneak up. And while this won't kill Mastercard, if any of these types of things go through, there's actually the banks who basically are issuing the cards themselves and are collecting the interest and everything. They're the ones who actually would take the brunt of it. It would basically slow down consumer credit, and that potentially would basically have a negative effect on the growth rate. So that is something you kind of have to factor in, that this is something that is starting to pop up on both sides of the political basically table here in this economy. And well, it doesn't look like it's likely to basically happen this year. This is something that could start getting tabled again and could potentially happen. So if we pop up the revenue with estimate here, well, we already saw it basically growing at that 13% a year. And if we pop up our EPS without the NRI with estimate, this is actually growing basically at 16% per year, which is pretty much in line with they've done historically. So that's kind of what the analysts in the market are basically current pricing in. So you kind of have to look at this company, which has been fairly consistent, and we can really just use something like the PE to kind of value it. So let's just get a little shorter time frame to take out that. And Mastercard, it typically has traded at a little bit higher PE ratio. You can see basically for the last few years, sometimes these really higher rates are because non-recurring income factors, as they'll show. But on the higher side, typically they get around this 40 PE ratio. That's kind of the higher premium basic value for it. So they definitely are trading on a little bit of the relatively cheaper side, assuming the current growth rates basically going forward at around a 28 PE ratio, because that was kind of the bottom in 2022. It was actually even the bottom in 2020. But you do have to consider basically pre-2018, the company did trade basically a little bit cheaper. It was trading down to 25 there, 23, and even in 2011, albeit this was over the great financial crisis, it was trading below 20 PE ratio. And that's also one of those things. If there was basically a little bit of recession, slows down consumer spending, well, you would expect the multiple basically to compress quite a bit on Mastercard, because, well, they are projecting, oh, there's going to be this, 16% compound annual growth rate for the EPS in, over the next 5 years. In the short term, if they're saying, oh, it shrinks to something 10%, well, that's a lot different. And then the company, basically at 10%, may be more valued at a 20 to 30 PE ratio versus closer to, a 30 to 40, basically. So I'll show you in a little calculator, basically, how we can kind of look at that and look at the potential growth rates we would get. And we've popped the price to sales ratio. And you can see, relatively speaking, for these margin rates, again, this is on the relatively cheaper side, at least in the shorter term here. But once we go back, that there's definitely 17 and below, they were sitting at more compressed multiples. But even if you bring up the EPS again here, just let me get the EPS with estimate. They were still growing at a good clip, basically you had 220, 261 to 307 and 377 there. So that's still was averaging pretty much what the growth rate is expected going forward. So kind of just even loss of confidence in a little bit of consumer short term, that is something that can lead to basically a lower multiple for Mastercard here. And then I'll just show you kind of where these P ratios look like. Let's bring up the price to mid P ratio. And you can see basically when I was underneath it, this is an average P ratio of actually 33 here. And you can kind of see the under over, and usually under was good times to buy. And you can kind of see that if we actually take, for example, 40 PE here and let that pop up. Why is that so far down? 40 doesn't make sense. I think that's not calculated in a 40 correctly, since it should not be $69. I think it's calculating in a 4. So let's try that again and get that to go. There we go. That makes more sense here. You can see if we put in the 40, and let's just bring up the P at the same time here. For the most part, this has been more of the upper trend. Other than here, there was, a little bit of basically something happening where the revenue base, well, because of what we all know, 2020 and everything, it temporary dips. So that's the only reason it was really trading higher, because the market kind of knew, oh, this is going to pass and, things are going to kind of more normalize. But historically in the past, the 40 has kind of been the upper range of a more normalized PE ratio. So on the upper side, that's kind of what I would target basically for Mastercard here. And the next thing I was going into, I'll just get into my little, basically kind of just kind of projects what your potential compound annual growth rate would be. So we can see right now that basically in the 2030. So we can see right now the current estimated basically compound annual growth rate is sitting about 16%. And I kind of have these two P ratios on the higher end set at 35 to 40. And this is something that you would basically expect to achieve if they do achieve a 16% compound annual growth rate in EPS. This is pretty a norm for basically the market. And, if you held it for 5 years, or, well, yeah, basically just under 5 years until the end of 2030 there, you would basically, from 35 to 40, probably average basically a 21 to 25% growth rate. And basically really what changes at this point here is well, if the stock gets re-rated lower. If the stock gets re-rated lower because suddenly this gets a little bit on the lower side and they're saying, hey, we're going to trade now between a 20 and a 30 PE, you can see how those numbers change quite a bit, and it's definitely not as an attractive purchase basically at this price. But, we don't know if that's going to happen. But even if you did buy it now over the longer term, 17% is still actually, pretty good overall. But if we go into the chart here, I'll just kind of show what's been happening. I have this longer term trend here, but the problem is this trend's been going at 21%, and when you're only growing at EPS at 16%, that doesn't really make sense. So, it's kind of time to delete that. And I kind of made this trend here, try to just match it up with the moving averages, project where the trend could basically be going forward in the future. So, kind of right now at Mastercard, I can definitely see it could be an attractive, price to purchase right now. Although I think due to the, the uninverted yield curve, uninverting and this and that, there could be a little bit of economic turbulence, a little bit of recession coming, potentially, even if it's just a light one. It doesn't have to be 2008 like that, but that could basically potentially in the short term garner a lower PE for Mastercard. And that's why I'm looking at this level right here at about $400, or at least see where this base is. It can either, like last time here, you actually look at, kind of come down and punctured this moving average here basically, which is on the monthly, the 50-month moving average. And, it's very likely that it could, kind of chop sideways and puncture that again. And at that price there, it definitely would be on the more attractive side to buy, even down to, 400 if something, were to really go wrong. And I would say these interest rates basically were to kind of lower like this, 400 would definitely be kind of a very attractive price to buy it, because you're right above this price volume profile. It's kind of meeting this bottom of this 16% longer term growth trend, which even if there were a short term slowdown, I don't believe that there's anything right now, though you would have to reevaluate, that basically is slowing down basically Mastercard to be below the 16% quite yet. But just like I said earlier, if there's just even the perception in the short term that it's going to be below that 16%, the basically stock is going to reprice it down. And if you can kind of see, if we take that and we just change the current price to, 400, at least if you're kind of getting in at that 20 PE, that, does start looking basically at a little bit kind of better of a more protective rate, even for the slower growth scenario. And then in the future, if you were to reaccelerate back to the higher growth scenario, there is actually, quite good returns that you could make. So anyways, that's my thoughts on Mastercard. Overall, it is a very good company. It really comes down to, what do you believe the EPS compound annual growth rate is going to be? And if there's going to be basically any short-term headwinds in the future, and the market thinks that therefore their EPS, even for 1 year or 2 years, is going to decelerate from 16%, the market will re-rate this down, probably down to a closer 20 PE. But anywhere you get close to $400, like it's kind of just seems like a steal at this point to buy, because like I said, even at if the current price was 400 and you're talking, a 20 to 30 P ratio, more on the more conservative side, you can still get good returns at that. And basically, if it were to reaccelerate then above the 30, you have a lot of potential upside there. So anyways, that's basically my thoughts on Mastercard. That's the basically analysis, which is mostly a valuation question. Make sure to subscribe to the channel, like the video, and I will see you in the next stock analysis.